Welcome to the deep dive. We take sources you're curious about, pull out the key insights, and basically give you a shortcut to getting up to speed on complex stuff.
And today, we're digging into Ruchir Sharma's book, What Went Wrong with Capitalism. It's quite a read.
Definitely. For this deep dive, we're using excerpts from the book itself, really getting into Sharma's own words and arguments.
Right. And our mission, if you like, is to unpack his view on how capitalism has changed, the government's role in all that, and, the challenges he sees ahead.
And the potential solutions, too. We want to make these, let's face it, sometimes dense economic ideas pretty clear and hopefully give you a few of those aha moments along the way.
That was good.
Okay, so where does Sharma start? He kicks things off looking back, right? His early days in India.
Yeah, as a financial journalist, it's interesting. He sets the scene with India's first big reforms after Gandhi under Finance Minister Manmohan Singh.
And there's that quote he mentions, Singh feeling lonely.
Exactly. Singh apparently said he had a strange feeling of loneliness, even as these sort of hopeful reforms were getting underway. It's quite poignant.
It really sets a tone, doesn't it? And then he immediately draws this contrast, India versus East Asia.
Right. South Korea, Taiwan, Singapore, and especially China. He looks at their growth after the 90s compared to India's.
And the difference in income growth is, well, it's pretty stark. What are the numbers he uses?
Yeah, this is where it gets, really striking. He points out that back in 1990, average incomes in China and India were roughly the same.
Okay.
But fast forward to when he's writing the book, and China's average income had jumped like 40 times to $12,500.
40 times, wow. And India?
India's had only gone up about sevenfold to around $2,400.
Big difference. So even back then, Sharma's seeing the state's influence maybe holding things back.
That seems to be the implication, yeah.
Right.
That maybe too much state involvement was hindering that kind of dynamism you saw elsewhere. And that idea, keeps coming back throughout the book.
Which brings us right to his main argument about developed countries today. He's basically saying they're now doing what he thinks slowed India down.
Expanding the state, you mean? Welfare, regulations.
Exactly. He argues they're growing the size and reach of government.
So are they kind of repeating history? Potentially undermining their own growth?
That seems to be his concern. He looks back at the U.S. government's growth since the 30s, Roosevelt, the New Deal, sees that as an early sign.
Right. And he mentions Reagan trying to push back in the 80s.
Yeah, but he argues those efforts to shrink the state were, not entirely successful and definitely temporary.
And now, under President Biden, he sees what he calls a new Washington consensus.
Yeah, a sort of renewed commitment to big government.
And it's interesting. He suggests this isn't just one party. He thinks there's a kind of bipartisan drift towards a bigger state.
How so?
Well, he notes that Republicans, while they might talk about limiting government, often focus more on social issues these days, rather than really pushing back hard on state control of the economy.
Okay, I see. And this leads to his core thesis, right? The real heart of the book.
Precisely. He argues that a lot of the economic problems we blame on market failures, things like inequality, big corporations getting too dominant, he thinks they actually come from government excesses. Especially, he says, constant meddling in the financial markets.
Okay, so what does that look like in practice? How does government excess cause these problems?
Well, his argument is that when the government becomes such a huge player in the market, it messes up price signals, the things that normally tell businesses where to invest.
So capital doesn't flow where it's most needed.
Right. It tends to go where regulation is lightest or where there's the most government support, like subsidies or guarantees, not necessarily where it's most productive.
And this creates a cycle.
Yeah, a dangerous one, he thinks. Each crisis brings bigger bailouts. That means more debt, the system gets less efficient, more fragile.
He talks about the 2000s and 2010s specifically, doesn't he? Governments pumping money into economies that were already recovering.
He does, and it's a somewhat controversial point. He argues that those interventions, meant to help, actually backfired.
How?
By flooding the system with easy money, they just created more debt and, fueled excesses in the financial markets, not necessarily real sustainable growth.
Okay, let's zoom out a bit. He also looks at the long-term picture, right? Government spending as a share of the economy in these big capitalist countries.
Yeah, the leading capitalist economies, as he calls them, US, UK, Germany, places like that. He tracks spending since the 1930s.
And it's gone up a lot.
Massively. On average, he says, it's quadrupled to about 48% of GDP. Though there's a range.
Right, like the U.S. is lower, France is higher.
Exactly. He puts the U.S. around 36%, France up at 58%. And another key trend he highlights is persistent deficits, spending more than they take in becoming the norm from the late 70s onwards.
And that's where the debt really starts to climb.
Hugely. Central government debt in these countries went from about 21% of GDP in 1970 up to, well, a staggering 140% during the pandemic.
Wow. And what are the consequences of relying so much on debt?
Well, one thing he points out is that managing the economy increasingly falls to central bankers, people who aren't elected.
Because politicians find it hard to make unpopular spending cuts.
That seemed to be part of it. Voters expect action, and borrowing or printing money is often easier politically than raising taxes or cutting spending.
He uses that analogy, doesn't he? The revolution in pain management.
Yeah, it's quite vivid. The idea that we now expect the government to step in and numb any economic pain, just like we might reach for strong painkillers for minor discomfort.
Which leads straight into the whole bailout culture.
Right. He contrasts the older, more cautious approach, like Bajhat's idea of lending only to solvent banks at high rates, with what we saw after 2008, and especially in 2020, much bigger, broader interventions.
He reminds us that the Fed got powers for emergency loans back in the 30s, but the scale now is different.
Completely different scale and frequency, yes. And he argues this constant safety net has allowed zombie companies to survive.
Zombies. You mean firms that aren't really viable?
Exactly. Companies kept alive purely by cheap debt and the prospect of bailouts, not because they're actually profitable or productive.
And how does this connect to overall economic growth?
Well, growth ultimately comes down to two things: more people working, or each worker becoming more productive. Sharma points out that productivity growth has really slowed down since the 1980s in most major economies.
Okay. Now, what about the idea that government has actually been shrinking? You hear that sometimes.
Sharma says that's basically a myth.
A myth? How so?
He argues it was an illusion created because global financial markets grew so incredibly fast. That explosion of finance happened alongside government intervention, especially easy money policies, not because government got smaller.
So the state was still growing, just maybe less obviously.
That's his point. He argues that while some emerging economies did privatize or deregulate in the advanced capitalist countries, the state's power and reach actually kept expanding steadily. The perception didn't match the reality.
And that expansion happened in two main ways: the welfare state and the regulatory state.
Correct. Social spending as a share of the economy kept going up, and the number and complexity of regulations also increased continuously.
He has a stat about benefits for poorer Americans, right?
Yeah, quite a striking one. He says direct government benefits for the poorest 20% of Americans more than doubled as a share of their total income, reaching 68% just before the pandemic hit.
And he looks historically, too, at taxes in Europe.
Showing significant growth in taxation in major European countries since the early 20th century.
But he pushes back on the idea that high taxes after WWII fueled the boom.
He does. He argues it was more about borrowing. Debt, he suggests, played a much bigger role than high taxes in funding the expansion of the welfare state back then.
And he uses the UK as an example of this long-term trend, spending and debt rising even in peacetime.
Right, showing how peacetime spending and borrowing gradually accumulated, setting the stage for crisis levels when things like the pandemic hit. He quotes Nick Timothy talking about the UK's addiction to cheap credit.
Okay, let's shift to more recent policies. He mentions the Biden administration's industrial strategy.
Yeah, the modern American industrial strategy, aiming to boost public investment.
But Sharma reminds us regulation isn't new either. Nixon.
Right, he points out that regulation expanded significantly under Nixon, moving into areas like the environment, workplace safety, beyond just traditional economic rules.
And that trend of more regulations, especially costly ones, continued under both parties.
Yes, he shows a sustained upward trend in those economically significant rules, the ones costing over $100 million, regardless of who is in the White House. Biden's approach, he notes, tends to emphasize the benefits, maybe more than strict cost-benefit numbers.
And this idea of a global regulatory hegemon, what's that about?
It's the observation that even when governments talk about deregulation, it often just means different regulation, sometimes more complex. Thatcher's Big Bang in the UK financial sector is his example. It deregulated some things, but led to a whole new complex regulatory framework.
And attempts to get around rules can have unintended effects too, like Regulation Q.
Definitely. That rule limited interest rates banks could pay, so the financial industry invented new products like money market funds to get around it, which fueled Wall Street's growth.
He contrasts different types of deregulation, doesn't he? Airlines versus savings and loans.
Yes. Airline and trucking deregulation, he argues, mostly led to more competition and lower prices. But deregulating the S&Ls, especially while keeping government deposit insurance, created incentives for excessive risk-taking.
The old 3-6-3 rule. Borrow at 3, lend at 6, golf at 3.
Exactly. That environment, combined with bad incentives, led to the S&L crisis, and lots of zombie thrifts insolvent institutions kept alive artificially.
Then there's the repeal of Glass-Steagall,
which separated commercial and investment banking. That happened in the late 90s. Sharma points out that even as that barrier fell, other financial regulations increased, but we still saw this explosion of complex debt products leading up to the 2008 crisis.
And after 2008, when rules on big banks tightened,
the risky stuff just moved elsewhere, right? Into the shadow banking system, which had less oversight. Their share of the mortgage market shot up.
He also talks a lot about private equity.
Yeah, fueled by all that easy money.
Yep.
He argues PE firms became more focused on financial engineering refinancing debt rather than actually building new businesses or improving existing ones long term. The growth in the number of firms and the money they manage has been huge.
And private lending grew even faster.
As an even less regulated alternative, yes. He quotes Karen Batrou saying, basically, activity flows to where the rules are least costly.
So his overall point is that rules alone can't stop speculation if the underlying culture is all about easy money and bailouts.
That's the core argument, yes. The incentives created by easy money and the expectation of rescues overwhelm regulatory efforts.
Which brings us to another consequence, oligopolies. Big companies dominating markets.
Right. He argues government actions help create this situation. Things like weaker antitrust enforcement, more regulation in other areas making it harder for small players, and again, easy money favoring bigger, established firms.
And we see this concentration in the stock market.
Hugely. The top few companies, especially big tech, Apple, Microsoft, Alphabet, Meta, NVIDIA, make up a record share of the market value.
While smaller, younger companies are disappearing from public markets.
Yeah, they're either getting bought up by the giants or choosing to stay private because going public is so complex and costly due to regulation. He cites census data showing concentration increasing in most U.S. industries since 2000.
By how much?
A striking 90% average increase, apparently.
It's amazing when you realize how many different brands are owned by just a few parent companies. Jewelry, coffins, dating sites.
Beer brands, too. It's widespread. And Sharma contrasts this with the past, like before the New Deal when the U.S. was much tougher on monopolies or trusts.
The progressive era goal was industrial liberty, more competition.
Right. And he notes that the rate of new business creation was actually higher back then.
He even suggests Europe might be doing better on antitrust.
It's counterintuitive, maybe, given Europe's reputation for state champions, but he argues their antitrust regulators are often more independent and aggressive, leading to more competitive markets in some areas compared to the U.S. in recent decades.
Though the current U.S. administration is talking more about antitrust again.
Yes, Biden's administration has signaled a renewed focus, especially on big tech. Whether that marks a real shift remains to be seen, I suppose.
Okay, another huge area of government intervention Sharma focuses on is the financial markets directly. The Fed buying bonds.
Yes, the Federal Reserve becoming a massive buyer in the Treasury market, especially since 2008. He points out it's similar to what happened in Japan. The Fed's holdings of government debt just ballooned.
And he argues this distorts everything, creates an easy money machine.
That's the idea. He quotes commentators talking about the nationalization of financial markets, or capitalism turning into statism because the government is such a dominant player, warping price signals.
And this easy money has fueled the massive growth of financial markets compared to the real economy.
Undeniably. Global financial assets have grown much faster than global GDP. And he notes that since WWII, financial crises are increasingly linked to economic recessions.
It's weird, isn't it, how sometimes bad economic news is seen as good for markets?
Because it means the central banks will likely step in with more easy money, right? Sharma argues this government backstop has sort of disconnected market performance from actual economic health. Markets go up almost regardless.
And bailouts keep default rates artificially low.
Which means the next rescue has to be even bigger. It's a cycle. Plus, there's the worry, voiced by people like Jeremy Grantham, that all this stimulus money ends up fueling inflation more than real output.
During the pandemic, the Fed even bought corporate debt directly.
Yes, holding debt in major companies across loads of different industries, a really unprecedented step. We also saw profitless companies having successful IPOs. The risk gets socialized in bad times.
And smart money just follows the subsidies now, like into green tech.
Sharma suggests that's happening, yeah.
Mm-hmm.
Investment decisions driven by government policy rather than pure market logic. And meanwhile, the really high-growth opportunities might be shifting to private market
Which excludes average people.
because the investment minimums are so high, yes. Ken Griffin raised that concern about AI companies staying private. Ordinary investors miss out on participating in potentially huge growth stories.
So, tying this all together, the impact on inequality, especially between generations.
Yes, Sharma argues propping up financial markets overwhelmingly benefits older, wealthier people who own most of the assets.
While younger generations are struggling.
He shows data on wealth stagnation for families under 35, while wealth for those over 65 nearly doubled between '89 and 2016. Student debt, mortgage debt. Younger people hold a much smaller share of national wealth.
And it takes way longer to save for a house deposit now.
Dramatically longer. More young adults living at home, too, many blaming what they call a broken economic situation.
And this isn't just a U.S. thing. He mentions France and Sweden having lots of billionaires, too.
Right. Even countries seen as more socialist have high wealth concentration at the very top, a kind of second Gilded Age. He notes the French protests against raising the retirement age alongside calls to tax billionaires more heavily.
So everyone agrees inequality is rising.
Pretty much across the political spectrum. But Sharma's point is that just tinkering with the rules, more regulations, slightly different taxes, doesn't fix the root cause.
Which he sees as.
The whole culture of easy money, that's what needs to change in his view to really tackle corporate and billionaire gigantism.
Okay, what about productivity? We touched on it earlier. It's slowed down a lot since the 70s, despite technology.
Yeah, the big productivity paradox. There was that brief uptick in the late 90s, early 2000s.
Which he says was mostly retail, Walmart using data.
Largely, yes, applying basic data technology efficiently. Now, everyone's debating if AI will finally break this slump.
But he points out something interesting about concentration and productivity recently.
Yes, the link seems broken. Historically, sometimes concentration correlated with rising productivity, bigger, more efficient firms. But in the last couple of decades, he says productivity has actually been falling in industries that are becoming more concentrated.
So today's tech giants aren't necessarily driving productivity like past leaders did.
He suggests maybe not, compared to, say, the impact of companies like GM or GE in their heyday. And he argues rising inequality itself hurts productivity.
How?
By reducing investment in people, by concentrating profits instead of spreading opportunity, by creating despair, maybe. And because the slump is so widespread across the U.S., he thinks it points to something systemic.
Like government debt.
Potentially. He links it back to those persistent deficits and rising debt levels, possibly acting as a drag on the whole economy.
So does he offer any alternatives? Countries doing things differently?
He looks at a few interesting examples. Switzerland first.
Often seen as socialist, but maybe not.
Right. He describes it as highly equal, very high net worth per family, but achieved through fiscal discipline. They aim for budget surpluses. That gives them more firepower in a crisis. He contrasts it with, say, Denmark, which had to reform its welfare state after 2008.
So the lesson is pragmatism, balancing enterprise and welfare.
Seems to be. Then there's Taiwan.
The Asian miracle focused on R&D chips.
Exactly, a leader in high-tech exports. But he highlights their relatively small government spending under 20% of GDP, small public sector. Strategic government support, yes, like science parks and recruiting key talent like Morris Chang for TSMC, but not massive state spending overall.
And the third one, Vietnam.
Yeah, Asia's latest success story, built on export manufacturing, even though it's a communist state.
How do they manage that?
By focusing on economic freedom, stable currency, infrastructure, and crucially, embracing free trade. Really impressive export growth for years.
Okay, so wrapping up, what's the path forward, according to Sharma? The U.S. still has appeal, right?
Oh yeah, he acknowledges that. The Yankee go home but take me with you idea. People still want to come to the U.S.
But optimism is low, trust in government is low.
Record lows in many advanced countries and historically low trust in government in the U.S., yes. And yet, the myth of shrinking government persists, while the culture of easy money and bailouts is deeply ingrained.
He warns about the U.S. getting complacent because the dollar is dominant.
Yeah, that being the world's financial superpower might make the U.S. less worried about its public debt than it should be. especially as other countries look for alternatives to the dollar.
So deficits do matter.
Absolutely, he argues. They drive up debt, they undermine productivity. We need to get back to running surpluses in good times and restrain those wildly experimental central bank interventions, especially when the economy is recovering.
It is ironic, isn't it? Governments that people don't trust keep intervening more and more.
That's the supreme irony, he points out. Unpopular governments intervening constantly, possibly making the productivity problem worse globally.
He ends with an analogy about ecosystems.
Yeah, just like we're learning to respect natural ecosystems and intervene cautiously, maybe we need a similar caution with the market economy. Recognize its own complex dynamics, don't constantly try to override them.
So if we boil it all down from this deep dive into Sharma's book, the main takeaway.
I think it's that he argues the problems we see in capitalism today, inequality, slow growth, dominance of finance, aren't necessarily the free market failing. He argues they're largely consequences of too much government intervention, especially the easy money policies and the bailout culture.
Okay. Which leaves us, and you, with a final thought to consider. Given Sharma's arguments and the evidence he presents, what kind of fundamental shifts in how we think about government's role in the economy might actually be needed?
Yeah, if we want to tackle inequality and reignite productivity, maybe we need to look beyond just tinkering. And perhaps those examples, Switzerland, Taiwan, Vietnam, offer some different perspectives worth thinking about.